Hello, everybody, and welcome back. Today, my guest is Kelly Chung. Kelly is a senior fund manager, multi-asset at the Hong Kong-based asset management company Value Partners. Welcome, Kelly.
Hi, yes, thank you.
Kelly, today we want to discuss recent developments in the Chinese stock market. So the Chinese People's Congress recently confirmed the growth target for the economy of 5.5% for 2022. What needs to happen to ensure that this target remains achievable?
To a lot of people, this target seems to be a bit aggressive. However, I believe that the Chinese government actually has a lot of tools to use, both monetary and physical, to actually achieve that. And if we look back in history, once the government set this target, they rarely miss it. So I believe that the government is very confident that they are able to achieve this target. That's why they deliver such a target to the public. In terms of monetary side, definitely they have room to have like easing this year compared to the West, which a lot of the central bank need to hike rate this year. On the other hand, PBOC actually has room to cut interest rate because inflation is very well controlled in China. So that's why we think that stimulating growth and demand is the top priority for the government right now. And on the physical side, definitely there's a lot of room to help to recover the economy. For example, it has already been seen that credit has been loosening in selected areas. And also, we believe there will continue to be more infrastructure spendings. So that's why we believe that the 5.5 GDP target is actually achievable for China.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. So you already touched the next question. Inflation is back in the markets and with it the risk of further interest rate hikes. How does the situation in China compare to the West?
To the West, for example, you can see that in the US and Europe, inflation has already been in the highest over the last 40 years. It has been because both the US and Europe has gone through a kind of V-shaped recovery last year since the pandemic. And demand is still very strong right now. And with the supply bottleneck and also the high energy and food prices add on to the originally elevated inflation in the US and Europe. However, China is on a different cycle compared to the US and Europe. They are kind of leading in terms of the economic cycle because they already experienced the pandemic in early 2020 and they already recovered from the pandemic in 2020. And 2021, while the West, they are still in the V-shaped recovery, China has already been slowing down. So now China, the most problem in China right now is the slow demand. And that's why we've seen that, for example, CPI is still at a very low level. It is because mainly the demand is quite weak right now. And as a result, the government's top priority is to stimulate demand and have the growth recovery. That's why we believe that they have a lot of tools in order to do so. And inflation, of course, will be a concern as well to China because they are actually an importer of commodity and resources. However, because the base for the CPI is quite low right now, so the top priority is definitely to stimulate growth.
The Ukraine war has caused commodity prices to explode abruptly and first and foremost energy, but also food. So how does this development affect China currently? And also what impact does this have on your investment strategy?
The tension between Russia and Ukraine, one thing for sure is will increase the food and energy prices globally because Ukraine and Russia are both a big supplier of food and commodities in general. To Asia, some countries will benefit from it. For example, Indonesia and Malaysia, they are net exporter of resources. So definitely they will benefit from the higher commodity prices. However, for countries like India and China, they are net importer of resources. So they will for sure will also impact by the high commodity prices. However, as I said, because the base of the inflation has been low, so even with these higher commodity prices, there's still more room for them to tolerate for a little bit higher inflation. So compared to the West, right, the US and Europe, as I said, they're already at elevated inflation level, which has been the highest since 40 years ago. And now on top of the Ukraine and Russia tension, which increased the commodity and food prices, so their inflation will be even more intensified. However, Asia will be in a better place to cope with this commodity inflation this time.
The Chinese government has imposed another lockdown, and global supply chains have been hit hard again. How much does this affect Chinese companies currently?
China has already experienced lockdown back in February, March 2020. It was the first country that actually locked down some cities during the pandemic. With the past experience, we believe that China knows very well how to manage the lockdown this time. And as you can see, for example, Shenzhen, it started lockdown last week. And after actually 5 days, a lot of things have already resumed normal. So since this week, a lot of factories has already restarted. And most of the operations have been quite normal. And this time you can see that the exchange didn't actually stop. Last time the exchange was closed for a couple of days. So we believe that after the experience in the past 2 years, China actually know very well how to handle the situation. So to the economy itself and to the companies, we don't think the impact will be that much. Of course, to the supply chain, because of the factory lockdown in like a couple of days, there will be some delay in terms of the shipment and also the output. However, it will be only very short-lived, and we don't think it will have any economic impact.
Chinese real estate market has seen a shakeout in 2021 due to high leverage and of many real estate companies running into financing trouble. What is China's progress in dealing with the real estate crisis, and how attractive is the sector after the reforms now?
As you know, during the past decade, a lot of the Chinese developers have been taking on leverage in order to expand their business. And the demand during the last decade in the Chinese property market was very huge. And that's why it made the growth was significant, and high growth will actually lead to these companies even at a higher leverage. So the government started to clean up some of the excessive leverage in the industry and try to consolidate it to make it healthier, starting from about 2 years ago, when the government first imposed the free red lines rule in the Chinese property market. After a very difficult year last year, some big companies are kind of already in the process of restructuring, and a lot of the companies' leverage has already come down to a very healthy level. And also, a lot of the state-owned property company has been buying assets from the private companies and helping them to clean up some of the balance sheet. So we think that after a very difficult last year, this year it will become a better year for the sector. However, there are, of course, some smaller developers still have their financing difficulties, facing a lot of maturities due. However, as the Chinese government has already mentioned, they are going to have a more coordinated plan to restructure some of the developers and the sectors. So we believe that with the policy support this year and going forward, it will be a much more healthy sector for the whole economy.
Chinese equities have had a disappointing year 2021, not least to the real estate industry performance, but also due to regulatory measures under the common prosperity theme. What is your outlook for Chinese equity in 2022, and why should investors currently remain engaged?
Especially last week during March 11 to March 15, these couple of days, the Chinese market experienced a very high volatility. It was because there was concern that some of the ADRs in the US would be delisting, and also there are growing concern about ongoing regulations over, for example, the internet sector will have more prolonged impact to the overall economy. However, with the speech by Liu He on March 16, it actually was the first time that different departments in China coordinated to come up with a very strong stabilization message. This is actually very symbolic and the first time for the Chinese government to do so. It actually addressed many of the concerns in the market, including, foreign listing of Chinese companies, as well as the regulations over different sectors and industries. So we believe that these regulations will somehow continue because of the common prosperity theme. However, the message going to deliver will be much more coordinated, and also it will try to deliver the message to have the least market impact. Therefore, after a very volatile last year, we think the peak of the regulation risk has already reached, and the surprise to the market should be much less going forward.
So this was Kelly Chung, Senior Fund Manager at Hong Kong-based Value Partners. Thank you very much, Kelly, for being with us today and sharing your insights into the Chinese equity market.
Yeah, thank you very much. Very happy to share with you.